everyone. It's Larry Kotlikoff. It's December 17th, 2024. I want to wish everybody happy holidays and the best for the new year. But it's winding down. 2024 is winding down. I thought I would talk to you about the state of the U.S. economy and the international economy at this moment. There's obviously lots of uncertainties, but I thought I would go through some information, some data, some thoughts from other people about where things stand, some facts, and then talk about some of the uncertainties that are facing us. But things are a lot better than, economically speaking, than one might have expected or hoped. And also the geopolitical situation in some ways is better, in some ways is looks more dangerous, but we'll talk a little bit about that as well. So what I'm going to do is share my screen here, and let me just figure out how to do that. Here we go. Okay, just have to make a few adjustments. Okay, I hope everybody can see my screen now. What I want to do is kind of start out with talking about something that's on a lot of people's mind, including the minds of the governors of the Board of Governors of the Federal Reserve, what's happening with inflation. So here's an article by Thorsten Sloke and colleagues. Thorsten's been on Economics Matters, the podcast, a couple times. He's the chief economist for Apollo Global Management, and he's seeing some signs of inflation coming back. But if you look at the most recent today's version of zvbodhi.com, he's got this chart. Zvi is a emeritus professor at Boston University from our business school, an old-time friend of mine. And what he shows in this chart that you can look at any minute of the day is the prevailing 30-year TIPS rate, the internal yield, and that's about 2.27. And the yield on 30-year nominal treasuries is 4.55. So the difference is about 2.27. That's what the market is saying long-term inflation is projected to be. Now, in the short term, you can also look at short-term projections of inflation. Short term, the market thinks that if you look out 5 years, the inflation rate will be 2.4%. Now, that's a little bit higher than the Fed's 2 percentage point long-run target, but both of these numbers are above the target. So, but the interesting thing is that this long-term inflation projection that the market's generating is no different than it was 6 months ago. That it's really stayed around that level, 2.25, for the last 6 months. So inflation expectations are pretty stable, long-term expectations. Short-term expectations are not, particularly high. 2.4% is not a whole lot higher than 2%. It's clearly higher than we saw in the late 2018, 2019, before COVID. But we have had cumulatively about 25% inflation from 2019 through today. So inflation's a big concern, especially if you're investing in long or even medium-term nominal bonds. On the other hand, if you're investing in inflation index bonds, Treasury inflation index bonds, they're adjusted for inflation. So at least what you're going to get before taxes is inflation proof, as long as the federal government doesn't default on its debt. We'll talk about that in a moment, if that's a possibility. But with the fact that the inflation kicker to tips is taxable, then there is a risk of having to pay higher taxes if inflation takes off. But in any case, having just been burnt to the tune of 25% on any nominal bonds that you held back in 2019 and continue, if you continue to hold those over the following 5 years, you lost 25% of the purchasing power. So uh, I would say that the projection of inflation is pretty stable, it's pretty low, but the risk of inflation remains, of inflation taking off, remains high. We just saw in the most recent report from the uh, from the about the CPI from the Bureau of Economic Analysis, from the BLS, Bureau of Labor Statistics, that the inflation's running over the last 12 months around 2.7%. So that's a little bit on the high side compared to what's being projected out 5 years. Anyway, so keep an eye on inflation, particularly concern yourself with the variability of inflation. The fact that we just saw a 25% increase in prices over the last 5 years should give everybody pause about investing in inflation sensitive securities. Now, the one reason that we need to be worried about inflation has to do with our fiscal policy. So here's a chart from the Federal Reserve of federal debt as a share of GDP. This is a total public debt, so it doesn't net out the debt that's being held by the Federal Reserve. Federal Reserve can print money and buy back federal debt, but I think this stat is probably the right one to look at: total public debt, regardless of who's holding that debt. And that, you can see, is about right now about 120%, 121% of GDP. It got up to about 133% of GDP going back 4 years ago, but it's actually declined during the Biden years. And why is that? Well, inflation eroded its real value. So GDP continued to rise in nominal terms, especially with inflation, but the stock of debt that was out there did not go up because that was, had a certain, book value and didn't increase. The 30-year bonds that were issued back in 2020 have the same book value as today as they did back then. And as a share of this higher level of GDP, the ratio is lower. So, so what you're seeing here is that the government is using inflation to pay its bills. It's making money to make money, and that may continue if the government can't get its fiscal house in order. You see, we've got 120% of GDP. Italy has, as a ratio of debt to GDP, even though we've wiped out, a good chunk of it through inflation in recent years, Italy has a 150% ratio of debt to GDP. So we're looking pretty bad if we're getting into Italian area with respect to debt to GDP. On the other hand, Italy actually has a much more sustainable fiscal policy than we do, because they're spending about 6% of GDP on healthcare. We're spending about 17, 18% of GDP. And that's been a stable number, so nobody expects that to go much higher. Maybe their healthcare is not as good as ours, although our performance when it comes to different metrics of healthcare quality, we're ranked about 21st in the world. We spend, again, 18% of GDP, and Sweden is spending about 11% of GDP. They're ranked fourth. So spending more money on GDP doesn't necessarily guarantee, more money on healthcare doesn't necessarily guarantee that you're going to get better quality healthcare. Anyway, Italy is in much better long-term fiscal shape despite the fact that it's got a high official debt to GDP because it's got its healthcare spending under control. And that's all state healthcare spending because their system is entirely a state-run healthcare system. In our country, about $10 out of every $18 is paid by the federal government or state governments on healthcare. So we're largely a state-run healthcare system as well. But the Congressional Budget Office is projecting our healthcare spending to go up dramatically as a share of GDP as Medicare and Medicaid spending goes up. Medicare, we know, is paid out to the disabled and people over 65, so it's mostly paid out to older people. But Medicaid is healthcare for very poor people. But most of that spending, about 70%, the last I looked, is being spent on older people who are in nursing homes. So these are poor older people in nursing homes. So we have to understand that Medicaid is also an old age healthcare program, just like Medicare. So what about our pension system? In Italy, they've had 4 pension reforms, and they've substantially reduced. Sorry about the siren in the background here. Italy has substantially cut its long-term pensions so that the replacement rate pensions, state pension as a share of or income before retirement is down to about the level in the US. It used to be much higher, probably about 40%. But that's all sustainable given that they've had these pension reforms. And that's one of the reasons why, if you look at that together with a control of healthcare spending, if you put everything together for Italy, including their debt, their official debt, and their other public expenditures, they're not spending much on defense. They need to spend more given Russia's invasion of Ukraine and their need to participate more actively in NATO. But right now, their projected fiscal gap, if you like, if you look at the present value of all their projected outlays and you subtract the present value of all their projected government receipts, all the money coming in versus all the money going out, what they're short is about 2% of GDP on an ongoing basis. They need to come up with extra taxes or cut spending by 2% of GDP to make their what we call intertemporal government budget balanced. We're short about 8 percentage points of GDP, 8 percentage points. So we're really in terrible long-term fiscal shape. Part of that has to do with our, obviously the official debt, 120% of GDP. But then if you look at Social Security's unfunded liability, you'll find this table. It's Roman 6F1 in the 2024 trustees report of Social Security. It was released, I think, last April. And it shows that the fiscal gap there is not 120% of GDP, which is about, $35 trillion or so right now. That's the official debt. But it's about, but the unfunded liability, the debt that's off the books for Social Security is $63 trillion. And this is the fiscal gap for Social Security. So if you project all of Social Security's benefit payments into the future and don't truncate the projection out at 75 years, which is what this number shows. If you assume that all our grandkids and great-grandkids are not going to get any benefits because we're only going to look out 75 years and not take into account the benefits that we're going to owe them. But if you look at all the benefits we're going to owe to everybody into the present, into the future, but discount benefits in the future at around 2%, that's what the Social Security actuaries who came up with this number are doing in forming their present value. You find that the system is short $63 trillion, taking into account the fact that we're going to be getting all this revenue from our kids and grandkids and future grandkids, great grandkids, uh, that's a big shortfall. And unfortunately, the rest of the fiscal enterprise that we're running can't bail out Social Security because it's in worse shape than Social Security. So the fiscal gap for the entire country, including Social Security, is worse than the fiscal gap for Social Security. It's the problem there is not that we're running a surplus on the rest of our fiscal activities, but we're running an even larger problem there. Uh, so we have to fix things fundamentally. And one thing you see in this table here is that one way we can fix things is to uh, come up with a payroll tax hike that starts immediately, raise our FICA payroll tax rate from 12.4 percentage points to 16.9. So have a 4.5 percentage point increase in the FICA payroll tax. That would be sufficient to cover in present value if you had a permanently uh, higher by 4.5 percentage points FICA tax. So the FICA tax goes up today to 16.9, stays there forever. Then you come up with an extra $63.8 trillion. So you see that that's not something that the politicians are talking about. Nobody in the election campaign talked about raising FICA taxes. They didn't talk about cutting benefits either, because you'd have to have a probably well, the projection is that the country is going to run short of enough money to pay Social Security benefits starting in 2034 by requiring if we don't raise taxes, a 21% benefit cut in that year, and then the benefit cuts would be even larger for future years. If President Trump gets his way and stops taxing under the federal income tax Social Security benefits, then the system will run out of money in 2031. So that's just 7 years from now. And we'd have to cut benefits by 33% starting in that year. So we have some major fiscal problem, and that goes back to the issue of inflation. Apparently, nobody thinks we have a fiscal problem in our country, that we're going to be printing a lot of money to pay our bills, because the inflation projection in the market is 2.27% long term. And even short term, it's quite low inflation projection. So how are we going to fix this problem of our fiscal gap? Well, one way to fix it is kind of not fix it and just ignore it, not talk about it. So most people in the country don't know we've got this major fiscal long-term problem. They don't know about the $63 trillion off the books unfunded liability for Social Security. It's an even bigger number if you did a Medicare calculation like this as well, a bigger number for Medicare. Uh, the so I think there's some lack of understanding about what's really going on. Now, we can come up with some major reforms for Social Security and the tax system. I read today that Senator Cruz is talking about a major tax reform. We could have a major Social Security reform where we would retire the old system, grandfather the old system, and put into place a new system where everybody contributes to their own account, and all the money is collectively invested by my laptop in a global index, so that Wall Street would have no participation, and the government could provide a zero real return guarantee, so that if the global financial market, which consists of all the stocks and bonds being traded, including government bonds and private corporate bonds, being traded in all the major financial markets in the world, talking about the U.S., the S&P and the U.S. bond market, and including the Treasury market, uh, and then the Japanese financial market and the European financial market. That's what I'm talking about here. not the Russian stock market. Uh, if they didn't deliver at least a zero real return, a return adjusted for inflation of at least zero, that you get back at least what you put in, the government would make good and beef up your account at retirement age. So we could have a reform of Social Security where we uh, basically can cut the payroll tax a little bit, gradually reduce it as we pay off the liabilities, the obligations under the old system, and then have a new system that raises uh, that's fully funded, a modern Social Security system. That would obviously put a bigger burden on younger people because they'd have to contribute to the old system, but they'd also be contributing to a fully funded system. But they'd have their own name on their own account, and we could make that a progressive system. We could have the government contribute on behalf of the poor, the disabled, the unemployed, and we could make it equitable in terms of uh, spouses, for example. They could each spouse's contribution could be divided 50-50 and going to each person's be divided 50-50, and so no matter who in the couple earns the money, each spouse would have an increase in their account that was of equal size, so that if they get divorced, and divorce is a very high, high probability event in our country, everybody would walk away with the same size uh, personal security account is the name I give for this. If you want to read more about this, go to kotlikoff.net, download my free book called You're Hired. It's just a 10 bullet proposal point, 10 bullet point proposal for how we can salvage Social Security. And we can do very major things like that with respect to the tax system, with respect to the healthcare system, with respect to the education system. There's major reforms we can undertake that are so major and so different from what anybody's been discussing that it's likely that since people will kind of see these reforms coming out of left field, they won't have a preset opposition. It won't be the knee-jerk Democrat saying forget about it and the knee-jerk Republican saying forget about it. It will be everybody saying, wow, that's an interesting idea, let's consider it. And we might actually find agreement across the, the two parties for something that's out of the box and very different. And we might then be able to get our fiscal house in order and and not have to worry about inflation being used to pay off our enormous fiscal gap. So there are answers here, but let me now talk about some other things that uh, we're facing. If we do have a reduction in immigration, then we're looking at our population, which is around 330 million now, heading up to about 366 at the end of the century. That's a lot lower than the UN or the census were projecting a couple of years ago when they thought that immigration would continue at its strong pace. Uh, but if it does continue, then we're talking about 435 million people at the end, Americans at the end of the century, or people in the U.S. at the end of the century. And the country, under the latest UN projection, and since I guess it's the census projection, we're getting older, and 3 in 10 Americans are going to be 65 or older in 2100. This is the number of kids under 18, and you can see that the number of walkers is going to greatly outnumber the number of strollers at the end of the century. It's going to be dramatically higher. So we're an aging country, just like Europe is aging, China's aging, Africa's even aging, even though Africa's population is going to explode. They're going to go from about 700 million people to about 2 billion people at the end of the century because they have so many young people who are going to come into childbearing ages and produce so many additional kids, even though each of those young people is going to have fewer children than their parents had. So Africa will be slowly aging over time, even though its population will be increasing. That's one of the fascinating aspects of demographics, that one thing can go in one direction, another thing can go in another direction when you think they're both going to go in the same direction. Not necessarily the case, maybe in the long run, but not in the short run. What about the European Union? Well, their population is projected to drop by 6%, not grow like ours is projected to do, but to drop by 6%. What about South Korea? They've got the lowest fertility rate of any country in the world. 0.76 is their fertility. That's the number of children that a woman during her childbearing years is expected to produce per woman. It's 0.76. But the woman has to reproduce herself, and the male, they have to reproduce themselves in males as well, and that requires having 2.1 children per woman of childbearing age, and that's the zero population growth fertility rate, 2.1. The South Koreans are down to 0.76. So their population, which is now around 56 million, is projected to drop down to about 12 million by the end of the century. So they have the most severe demographic challenge of any country right now. They've been trying to come up with different methods to encourage people to have children. But then before that, they have to encourage them to get married, because most people that have children in South Korea are married. But even before that, they have to encourage young people, especially young women, to go out on dates, because that's not something that many young Korean women appear to be all that keen on doing, at least from my most recent trip to South Korea. Seemed like there was a lot of, I don't know, far less connecting than one would expect, or certainly the one sees in the US. So what's going to happen in South Korea? Are they going to try and clone people, try and produce children in test tubes, perhaps come up with artificial embryos, or well, we have, I guess, artificial embryos. I'm talking about, I guess, artificial uteruses to grow children. That's all quite possible. We could have South Korea, if it's facing extinction as a country, it could come up with some new means of producing children that are not, the standard method that's been used since the beginning of time. So I expect to see something like that happen unless the fertility rate turns around, because I don't expect that South Korea or any country will stand by and watch itself disappear. Not likely. I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast. Now, what about China? China's birth rate or fertility rate is below 1 right now. It's around 1, but it's slightly below 1, I believe. It's certainly not 2.1. China changed its one-child policy that lowered its birth rate down to fertility rate down to one for years. It's now had a have as many kids as you like, or have more kids than two, please, because our fertility rate is so low. That's their current policy, and that's been in place for quite a while, and it hasn't turned things around. If anything, the fertility rate has gone down a bit. So their projection from the UN is that their population could fall in half uh, from about 1.4 billion down to possibly 700, 800 million, roughly in half by the end of the century. That's has enormous implications for China's position in the global economy. If fertility in China remained around, got back to zero population growth, ZPG 2.1, then China would probably have about 35% of the world GDP at the end of the century, and we would end up probably around 11% of GDP. There's a paper on my website, kotlikoff.net, called The Future of Economic Power, which suggests that China and India, under prior UN projections, which were a little more optimistic, at least for China, would end up with about 40% of world GDP, 45%, somewhere in there, by the end of the century. So these latest numbers suggest maybe China would end up with about 20% of world GDP at the end of the century, and the US around 10%, and India maybe around 11, 12%. What about Japan? Well, its population growth is also, its population is also falling. European Union, as I said, it's declining. Okay, let's look at some other things. Weekly real earnings. Federal Reserve is telling us that they're rising, but they went up a whole lot during COVID. Median usual weekly real earnings, but that was due to a composition effect. The employers laid off the least productive workers, so we had fewer workers during COVID, but they were the most productive, so productivity shot up. But then when the laid off workers were rehired, it dropped back down. So it's somewhat higher than it was. Why do I say productivity? Well, that correlates with real wages. But what we're seeing here is that real wages are somewhat higher than they were. So they've grown during the Biden years. They grew about the same rate during the Trump years. But they're not growing at a super high clip. It's basically 1% a year. And that's a little bit remarkable because US productivity growth has been pretty decent, around 1.8% or so. And that's GDP per person. So what's happening is that the typical worker is not enjoying and hasn't been enjoying the full productivity growth rate of the economy. And I'm talking really about labor productivity, real output per worker. So real output per worker has been growing more rapidly than median usual weekly real earnings by about 1 percentage point, and that's been true for a long time. And that comes back to, or is explained by, rising wage inequality, and we'll talk about that in a moment. I just want to show you employment is higher than it's been in the past, and it's not dramatically higher than it was going back a decade or so, but well, it's 161 million versus going back a decade, 147 million. So employment is keeping pace with the population. The unemployment rate is low. The out of the labor force rate is kind of stable. So on those scores, the economy is doing okay. It's not great guns, but what about the S&P? Well, the S&P has pretty much increased by 50% since over the last 2 years. So that's the big question, I think, in everybody's mind. Is that going to continue? Will we see some major correction in the market, given that price earnings ratios are quite high these days? Stock market capitalization, the value of the stock market compared to GDP, it's at a, if you go back to 1975 and you look at it where it is today, that ratio back in 1975 was 41. Now it's 194. So this might give people pause about staying in the stock market. They might think that the stock market's overvalued. Economists think that you can't predict the stock market because apart from the trend, the stocks have yielded since 1975 about 7.5% real on a geometric compounded rate. So there's a trend, but there's also a pretty big standard deviation. But the movement in the stock market, apart from the trend, is really unpredictable because it is based on new information, and new information is by definition unpredictable. It's something you don't know. So it's got to be a random piece of information. We could have some shocks that could lead us to having major corrections in the stock market. If you look at what President Trump past and future President Trump is saying about oversight of banks. He's saying, some people are saying we should get rid of the FDIC, maybe not the insurance of the FDIC, but combine the FDIC with the Treasury, with some other part of the Treasury. Okay, but if that scares everybody about whether or not their deposits are safe, that could lead to a potential run. We saw that with Silicon Valley Bank. We've got about $7 trillion out of about $17 trillion of deposits that are uninsured, that are over the FDIC limit, and that money could move overnight, as we saw with Silicon Valley Bank, out of the banking system into money markets, for example, and that could precipitate a major bank panic. And fortunately, we didn't have a huge one last time around, but that wasn't too far in the past. What else do we know? We know that Trump is interested in potentially privatizing Fannie and Freddie. That could make mortgage rates more expensive. I'm not quite sure what privatizing Fannie and Freddie mean. They were private. The Fed nationalized them during the Great Recession and then sold off their shares. So the federal government, not the Fed, I guess it was, yeah, it was the federal. I think it was the Treasury that basically took them over, nationalized these private institutions, and then sold off their shares. So they've been private. I'm not sure what it means to make them private, since they're currently private. But whenever you say let's change these things, these institutions that are kind of critical to the mortgage market, they buy up private mortgages that banks issue and then package them together and reissue them. So the banks know they'll have a market for your mortgage, so they don't have to have the full risk of your mortgage on their books. If you don't do it that way, you have to do banking a different way. But anyway, so that could, all these things that could get folks nervous could lead the stock market to drop. What about these tariffs that Trump is pushing? Well, he's talking about a 25% tariff on Canada and Mexico being announced the first day of office, ostensibly because Canada and Mexico are letting immigrants into our country. Canada has a border that goes over 5,000 miles between the U.S. and Canada. Presumably, it's supposed to take every Canadian citizen and have them stand at the border to keep immigrants from coming in from Canada into the U.S. But as far as I know, and everybody else knows, there's not a lot of immigrants coming from Canada illegally into the US. So it's not clear why we are going after Canada and Mexico. These are our major trading partners. Canada is, I think Mexico is our largest trading partner, and Canada is our second largest trading partner. Uh, but Trump has said he's going to put tariffs on other countries as well, and increase tariffs on China. He's talked about even 100% tariffs on China. Uh, the Then he's also talking about extending the Tax Cut and Jobs Act, because that's set to expire after next year, and we're supposed to go back to higher tax rates. The higher tax rates are here. So if you're in the top bracket now, which is 37%, you'd be in a 39.6% bracket. A lot of people are in the 22 and 24% bracket. They go up to the 25 and 28% bracket. So what does it cost to extend the Tax Cut and Jobs Act that was passed in 2017 into the future? It's $4 trillion. What about other things like not taxing tips, like not taxing Social Security benefits under the federal income tax, like cutting the corporate tax rate down from 21% down to about 15%. President Trump is saying that he wants to do those things, as well as not tax overtime earnings. If he does this stuff, I'm going to bring a tips jar into my class at Boston University and see if I can get paid in tips. And also try and schedule more of my classes at midnight, so that maybe I can get paid overtime and not have it taxed. So you could have all kinds of distortions happen if we start treating people differently. The Senate and the House are about to try and eliminate what's called the windfall elimination provision and the government pension offset provision. This would be these are provisions that try and treat, I think very imperfectly, treat workers who don't of state and local governments who don't participate in the Social Security system. They're trying to these provisions, the windfall elimination provision, the government pension pension offset provision, are trying to make sure that that those workers aren't treated better than workers who do contribute to Social Security their entire lives when it comes to getting Social Security benefits on very short earnings records. So a teacher in Illinois might spend their entire career basically working in the state teacher system, but then spend maybe 10 years working as a teacher in a state where Social Security is taken out of their Social Security taxes is taken out of their paycheck, and then they're going to qualify for Social Security. But under the current system, they're going to look like they're lifetime poor, because all their earnings for the state of Illinois will not be part of the earnings record. So since Social Security provides benefits on a progressive lifetime basis, based on your lifetime earnings, it's a progressive formula. So that means that we have these people being better treated than somebody earning less money, unless over their lifetime and paying taxes on all that money, unless we reduce their pensions from Social Security. And that's what the WEP and the GPO do. And the Senate and the House appear to be about to revoke the WEP and the GPO, which means that there's going to be a huge subsidy to working for state and local government. And that's going to produce a major movement from the private sector into the state and local government sector. So do you want to do this? Is this being thought out? Have the implications of this been really considered? I don't think so. Let me talk about some other things. What about European growth? It's projected to be less than 1%. Japanese growth is projected to be less than 1%. U.S. growth is projected to be about above 2% for the year. Talking about real GDP growth, China's real GDP growth is projected at 4.8%. That's a growth recession for China. But again, what you're seeing here is that China continues to grow, even if that rate is much lower than the 7-8% they have at least reported to be growing at in the past. So that tells us that China is still, moving ahead. Demographically, we don't know what's going to happen, but certainly China is growing at the moment faster than the rest of the world. Here's something that's interesting. This is a picture of what's happened to the S&P since December 07. And you can see that the S&P has been growing, but it's also, the standard deviation has been about 12%, as opposed to 20% in over the entire history of the stock market. So it might be that the stock market is somewhat less risky than it was in the past. And that may help explain why stocks have risen. If there's a smaller risk premium for investing in stocks, then you would expect stock prices to go up. What else can I tell you about? Well, the price earnings ratios are much higher than they were. For the NASDAQ, it's I think the price earnings ratio today for the S&P is about 30% higher than its average. And a lot of that has to do with the magnificent 7 tech companies bringing up the stock market. But if you look at an equal weighted S&P, you'll see that the price earnings ratio is closer to 17%. That's closer to the historic average. So currently the S&P is around, price earnings ratios around 22% versus maybe 15-16% historic average. So that's U.S. GDP growth, around 2.5%. It's higher than I just said, projected for this year. Wage inequality fell in 2023, but the top 1% earners, their wages have skyrocketed since 1979. They've gone up 182%, while the bottom 90% wages have grown at just 44%. So the average wage of the top 1% up 182% since 1979. Average wage of the bottom 90% up just 44%. So this is why labor productivity in the U.S. is growing much more rapidly than median weekly real earnings. It's because of increasing wage inequality. And does this mean that we're going to end up as a gated community? Is this connected to robotization, AI coming on board as well? I would say probably yes, that more and more jobs are being replaced by smart machines, and we can kind of project that to continue to happen. And labor share of total GDP has also declined somewhat, at the same time that more and more of that share is going to the most productive, or at least the highest paid workers. What else can I tell you? Well, if we think again about these tariffs that are being placed on Mexico and Canada, we're getting half of our fresh fruit and 69% of our vegetables from Mexico. We're getting, I think, about 20% of our oil imported from Mexico. We're exporting more oil than we're importing. well, we are a net exporter of oil, but the oil from Canada is coming into the Northwest. The oil from that we're exporting is going from the Gulf over, I guess, to Europe and Asia. So, you know, if you think about oil, it's a globally traded commodity. It's not like the Canadians are going to give us a break on the oil price that they're going to sell oil to us at. So what's going to happen is that uh, American importers of fruit from Mexico can sell their fruit to other places as well. They can sell their cars. They're producing a lot of our cars down in Mexico. Uh, they can sell them to other places. So these tariffs are surely going to be passed through in the form of higher consumer prices to the American consumer. So we should see gasoline prices going up maybe 30 or 40 cents a gallon is the projection. And whether this will be enough to kick off a real increase in inflation that's sustained, I don't know, but it's concerning. Certainly, Canada can ship their oil abroad. They don't have to send it to the US. And we're also seeing the potential for a trade war here. China has already announced that they're going to stop sending us rare earth minerals, which we need for batteries for electric cars. So this is one of the things that could lead through time to a stock market drop, either a plunge or a gradual decline. Inflation is, historically kind of where it's been since 1970. It's been much higher. It was much higher a couple of years ago, but it's now down again, most recently about 2.7%. So that's the picture for the U.S. Just internationally, I'm concerned that China might look at what's going on in the Middle East and see how inexpensive it is really to change the kind of the status quo using military means. It's been relatively inexpensive for Israel to change the whole geopolitical situation in the Middle East through military means. They have not lost that many soldiers. They've lost obviously a lot of international prestige, given how they've conducted the war. I'm not going to debate whether they've done it as with as much caution with respect to the civilian lives as could have been done. I don't have the facts on that, but clearly it's coming at a cost of international reputation. On the other hand, they have reduced a lot of threats and reduced Iran's military power. The U.S. could come in and use this opportunity to take out the nuclear development program in Iran. I kind of expect that to happen under President Trump. That makes the world in some ways more safe and peaceful. On the other hand, China could say, well, you folks are doing this over there. We're just going to take over Taiwan. And whether President Trump will decide that Taiwan is worth going to war for is an open question. So, but it could certainly lead to major stock market revaluations. Whatever happens, shocks generally lead to more uncertainty, and more uncertainty leads to a reduction in stock prices, not just the US, but globally. So let me bring this to a close and wish everybody again the best for the holidays and the new year, and say that the outlook on the fiscal side looks pretty bad. The outlook on the inflation side, at least people seem to think, be pretty pretty optimistic about long-term inflation. I'm not sure they're connecting the dots here, but there is a way ahead, which involves major structural reforms of our different policies. And then we also have these geopolitical uncertainties, including Ukraine. Clearly, if Russia somehow is able to take over Ukraine, that would change things dramatically in many, many different ways. So thanks again, and come back in the new year to Economics Matters. We'll have more podcasts and posts. And please do spread the word about this podcast and my newsletter. Thank you. Bye-bye.